If you're looking for a nice source of income and you're willing to take a bit more risk, then the cover call route might be just for you. So in this video, I'm going to break down what cover calls are, how they work, where to find them and how to screen them, and more importantly, how to actually invest in them. So let's get straight into it. What are cover calls? So cover calls are types of options trading. So in this case, you need to have at least 100 shares of a particular company or ETF. And what you do is you go into the market and say to someone, I've got 100, for example, Apple shares, and Apple is currently trading at $100 per share, let's say. I'm just making this up. And then you say, if Apple shares go up to $180 between now and say the end of the year by 31st of December, I will sell you Apple shares at that price. Okay? If it goes above that, then your quid's in. You can exercise your option to buy that at that price. So even if it goes up to 280, 290, 500, it doesn't matter. I'll have to sell the 100 shares at that price that we agreed. However, if it doesn't hit, then I still get to keep my Apple shares. But for you to be able to have this privilege of being able to buy at that price, you'll pay me a premium. So that price that we agreed is called the strike price. The amount that you pay me for entering into this contract with me, this cover call contract, is called the premium. So what happens then is, between now and December, we'll both be checking the price. So I'll get the premium up front, and then obviously with this, in this example, we've gone a few months out. So it may be a 1 month one, so 30 days, or it might be 2 months, it might be 3 months. So you say, for example, I've done a monthly one. At the end of the month, if that price has not been hit, then I keep the premium and I keep my stocks. If the price is hit, the person who owns who pay the premium, who owns the cover call contract, can exercise. They don't have to, they're not obligated to, but they can say, right, the price is now 185, I'm going to exercise it and pay 180 per share for the 100. You still get the premium, you get the money they pay you for the 180 times 100, so you're happy. However, it means that you're not benefiting from the upside. So if those shares then go on to £500, it's tough, you don't get that. But you need to be content with that. So that's kind of the risk of that. Now, the truth is, with us being in the UK, covered calls are not very popular here because a lot of the platforms that we use don't actually allow you to do them. There's only a few of them, such as Interactive Broker or Saxo Bank or Tasty Trade, that actually do it. The platform that I use, which is Trading 212, don't actually do covered call directly. So the way that I do it is by using a covered call ETF or cover call ETFs instead. So rather than going into the market yourself with your 100 shares and putting these cover call options into the market and then someone accepting your offer and then entering into this contract with you, you've got these companies that have already done the work for you. So they already own these shares. So it might be they've got 100 shares of Apple, or they got 100 shares of Nasdaq, the index, or S&P 500, wherever it is. They've already gone into the market. They've done it. So what you have to do then is to buy the shares of these companies that already have the covered calls in place, and when they get those premiums, they will then pay you dividends as an investor into their company. So in this video, I'm not going to show you how to put a covered call on directly, simply because the platform I have does not have the capability of doing that. If you want to learn to do that, then let me know and I'll make a separate video for that. But with this one, I'm going to concentrate primarily on the ETF version of it. Right, so where do we go? So this is my Trading 212. I'm sharing my screen now. Again, there are so many platforms out there. If you want to be able to do covered calls specifically, then maybe look into something like Interactive Broker. That'll give you the ability to put your own covered call yourself. But make sure you understand what you're doing. Make sure you know the intricacies and the risk that you're taking. Because even though the dividends are good, the premiums are good, you need to accept that if the price goes up and up, then you might not be able to benefit from that. Right, so once I'm on my screen, so this is my Roadman Investor Trading 212 platform. This is separate from my own actual platform. So this just allows me to, do these kind of videos. So if you just go into the search area there, you can literally type in covered, and this will give you a ton of them. So you got Nasdaq one there, S&P 500 one there, you got the Euro stocks there, you got all different ones. So you got some from Global X, which is the fund manager. You got some from iShares, X Trackers. You got all sorts there. So you want to decide on which one to go with. Now, by default, I typically go with ones in my local currency. So as you can see, this one is in pound sterling, is in dollars. This one's in pound sterling. This one's in pound sterling. This one's in euros. So because I don't want to further expose myself to the FX risk, so foreign exchange conversion. So if I was to buy something that's in dollars, but I've got pound sterling, there has to be an exchange, and that normally carries some sort of a risk, which means that if my pound sterling goes up and say for example the dollar goes down, there'll be a difference there. But if the opposite happened, my pound sterling goes down and the dollar goes up, there's also going to be an exposure there. So to eliminate that, I tend to go with ones in my local currency, which is pound sterling. Now, the next thing is, which one do you go for? You got this one here that's concerned with Nasdaq. So the Nasdaq is the index that tracks the 100 fastest growing companies in America, excluding the banking stocks. That means that they tend to be quite volatile, and because they're growing so quickly, and they tend to be tech stocks. If you want something a bit more balanced, you might want to look at something like the S&P 500. So this is the 500 companies, 500 biggest companies in the United States. So rather than just focusing on the 100 fastest growing ones, this has a bit more diversification and it's a bit more balanced. It also means that it won't be as volatile. So if you want something that's based on the European stock market instead, that's an option there. So that's the pound version of it. So let's have a look at one of them then. So if I go on this one, which is the Nasdaq one, you want to look at the performance. So overall, you see that they tend not to do very well in terms of stock price appreciation, for the reason I explained, because once it tops out at a certain level, then in most cases they'll have to sell, which means that you don't get to participate a lot in the upside of this. But in return, they tend to pay you very good dividends. So the yield on this can be as high as 10-11% sometimes. So let's have a look at a little bit. So you can see this is one that I'm already invested in, and as you can see, I'm down slightly on this. But just to get a bit more information, we're going to go to our trusted friend, the website Just ETF. So if you go onto the landing page of Just ETF, you can simply type in covered, and then you just click on search there, and this will break down one or two things. So as usual, I normally go for the total expense ratio first because I want to keep my costs down. The total expense ratio is the amount that the fund manager will charge you for managing those stocks for you. So the ETF that they've put together, they have to put stocks in and take some stocks out, and for the privilege of managing it, they will charge you a small fee. So in this case, it's 0.4%, which means that for every £10,000 you invest in that ETF, they will charge you £45. So looking at these, they're all pretty much the same, so that's not going to be a factor. The next thing I want to look at is if it's distributing or accumulating. So accumulating means that once the dividends are paid, rather than going into your account, your trading account, it will go on to buy more stocks of that ETF for you. So you'll automatically reinvest it. Now, if you're a young person, or if you're someone who basically isn't particularly interested in taking the income, you just want it to grow, the accumulating version might be for you. It might be that you live in a jurisdiction, in a country where the taxation system means that if you take that income, then you'll have to pay the tax. But because we live in the UK and you can buy this in an ISA, so the ISA gives you protection from taxation. It means that anything you earn is completely tax exempt. You don't pay any capital gains or VAT. You get to keep all of it. So we don't have to worry about taking the income being a taxable event for us. So for that reason, I don't normally go for accumulating funds. I prefer distributing. So for me, that automatically eliminates that one. Okay, so also you notice this says UCITS. UCITS mean that this is suitable for the European market. If it doesn't say UCITS, then you can't buy it in the UK or in Europe. Right, so let's look at this one, which is the NASDAQ 100 one, which is the distributing version. You can see the price there. Let's have a look at it a little bit closer. Let's see what we've got here. You can see the charts. You can see the performance. You can see year to date it's struggled. 5 years, it's not been going long enough. You can look at 3 years, not long enough. You can look at the past year, it's down slightly. So we saw this information on Trading 212, but just ETF just breaks it down a little bit more for you. You can see the fund size, total expense ratio. You can see where it's focused. So equity, that's just a fancy name for stocks. The country, United States, and it's primarily invested in technology because it's the NASDAQ, like I said. So the replication, synthetic. So with these, they're not actually buying the stocks, they're just using the covered call system, ETFs. So on here, you can just have a look at the different things. But importantly, you can see that these pay monthly, and this is based in Ireland, and the fund provider is Global X. So this will give you monthly payments. Every time they write their cover calls, they get their premiums. Every single month, you get a little piece of the pie. Right, so let's say we're happy with all that. This is what we want to go for. You scroll back up, and then you have a look at the ticker symbol there. So that's a unique symbol for this particular ETF. That's QYLP. So you go back in there, and rather than having 1,000 to look through, you're not happy to go with QYLP. You simply type in QYLP, like so, and that's the one there. Just make sure it's the right one. So you got the price there. Look at the performance. So with it being an income focused ETF, I'm not as bothered as the growth of the stock, as long as I'm making money overall. What do I mean by that? So it's the total returns that I'm interested in. So if this stock is down by say 7%, 7.9% for the year, and if you look at this one, since I've been in, I'm actually down 2.15%, but this is paying say 11% return. Overall, I'm up by 9%, because if I'm being paid 11% in dividends, but I've lost 2% in 1.3% in stock price, overall I'm still up. But if it was the other way around, say for example the dividends is 7% and the stock price is down by 10%, you've actually lost money, -3. So don't just focus on the dividend yield. Don't just focus on, how much money I'm going to get. Look at the overall return for you. So in this case, even though it's not going up gradually, which is one of the main things I look at, I'm actually satisfied to go with this because overall I'll be better off. So let's assume we're happy with this. This is one we want to go with. Let's look at a bit more information. You can see the volatility. It's relatively low on this, given that it's a covered call ETF. So that's a low volatility. You can see the price range over the past 24 hours. The range has been from £11.64 and £11.80, and over the past 52 weeks, so the past year, it's gone as low as £10.38 and as high as £14.90. So not very volatile at all. Right, so let's say you were not happy with this, we want to go with this. You simply click on buy. You're now left with two options. You got four options, but I'm only going to talk about two. So you got market, limit, stop, or stop limit. So for the sake of this video, I'm only going to talk about market or limit. So if you go with market, it means that the price shown on screen, the system will try to get as close as that as possible for you. So it wouldn't necessarily be £11.654. It might be 11.7, it might be 11.67. but the system will try to get you a price as close to that as possible. Now, if you want to go with the market, you simply click on the amount you want to invest. So for example, you want £1 worth. Because it's trading 212, they allow you to buy fractional shares. So it will simply give you £1 worth of shares. In this case, it's 0.085 shares of this ETF. Right, you just click on review. It'll give you a summary. So it's a market buy. The number of shares you get is £1, the value is £1. Number of shares is 0.085. Because it's trading 212 is commission free, check out your platform. Make sure that you keep those commission as low as possible, free if you can. And then this is the total. If you're good with that, you just click on send buy order, and then that's it. Jobs are good done. Instead, if you don't want that gamble, if you think to yourself, I don't want to pay more than a certain amount, say for example you want to cap it at £11.70, you can use a limit order instead and use the slider to put how much you want to buy. So again, £1 worth. You click on the price that you're willing to pay, the maximum. So let's say £11.70, and then you just click on review order, and again it'll give you a summary. So this time it's a limit buy, number of shares, the value of the shares, this is the limit price, or this is the maximum that you're willing to pay. If the system can execute that trade at lower than this, it will. If you can get it on bang on £11.70, it will, but no higher than that. That means that you don't have to lose sleep on overpaying. So for example, if you wake up and that's gone up to £15, with the market order it will execute at £15 or thereabouts. If this goes up to £15, it just won't execute. Now that's got a positive and a negative. The positive being you haven't overpaid if that's what you don't want to do. The negative being, if that stock continues to rise, say for example you execute at £15, but then it goes on to £19, £20 and never goes back down, then with a market buy you can participate with that. In a limit buy, you've lost out. So you just need to be comfortable with whichever option you want to go with. The expiration says never, so this will carry on trying to do it, and whenever it takes however long for it to reach that price, it will keep trying. And then if it does, say I don't know, in a month's time or 2 months time, it will execute. When the market is open, because we're filming on a weekend, when the market is open, it'll give you the option of expiration being at the end of the trading day. So it'll keep trying until the end of the day. If it doesn't find a suitable stock at the price that you've put, then it'll just cancel at the end of the trading day, and then the money will just go back into your trading account. Again, commission free, and it gives you the total. So all you have to do now is just send the order. Again, because we're filming on a weekend, this will execute when the market opens on Monday. So you just click on OK, you sit back and relax, and once that's executed, you're now a proud investor in a covered call ETF. That means that you've done all the work on your end. They'll go off now, do the covered call on your behalf, and when they get their premiums, in this case monthly, you get your little piece of that pie. You don't have to do anything else. Obviously, if you want that to grow, once you get your premium in the form of your dividends, you can just reinvest that and buy more of the ETF, which means that the next time you get a little bit more dividends, and you can keep doing that. You can dollar cost average, which means that you can set an automatic one, so you can buy it weekly, monthly, whatever it is that you can afford. So if you want to put £100 per month into this, you just keep putting £100, and then you also reinvest your dividends, let that compound, let that grow for you. And say you get to a certain point and you think, you know what, I'm ready to retire now, you can actually live off that money. You can use some of it to pay the bills. You can do whatever you want with it. You can use it to invest in something else. So it's purely passive after that. So I've gone through what cover calls are. I've gone through how they're executed. In the UK, it's not very popular, and only very few platforms such as Interactive Broker would actually allow you to put a cover call option in yourself. And even so, they'll do some sort of suitability test to make sure that you understand it. So to save yourself all that headache, you can just buy cover call ETFs instead. I've shown you how to find those, some things to do to analyze them to make sure that they're suitable for what you're looking for, where to find the tool, so just ETF website to analyze them, how to execute the trades on your platform. So in this case, I showed you how to do it on Trading 212. So if you're happy with this, you've learned something, make sure you like, make sure you subscribe. If you're invested in cover call ETFs, leave a comment below, let me know which ones. If you do cover call directly, then let us have a bit more information about which ones you're doing, any wins you've had, any losses you've had, any sort of information that might help others. Obviously this is to help people who are starting out or people who just want more information. So make sure you get this video out, share it, make sure your friends, make sure your family members, people who you know might benefit from it, let them watch this, let them actually start benefiting from the passive income from there. If you can't make money in your sleep, you will actually work till the day you die, and we don't want to do that. So it's been Roadman Investor. We're going to do many more of this type of videos. Make sure you click on that notification bell and join me next time. It's Roadman Investor.